Hey Snapchat, Paul LaRue has asked me to talk about term sheets, so I'm going to give you a breakdown on how term sheets work. The first and most obvious thing in a term sheet is the price. That's the price someone's going to pay to invest in your company. Price is usually expressed as pre-money valuation or post-money valuation. I'll explain. If I invest $2 million in your company at an $8 million pre-money, your post-money is $10 million. Pre-money plus investment equals post-money, and my $2 million invested owns 20% of the company. 2 invested divided by post-money equals the percentage I own for my investment. So it's not just price you may want to negotiate. Size of round is the second thing you want to negotiate. If someone sets a price lower than you want to take, one thing you can counter with is a lower size of round, which lowers your dilution. But that then obviously means you have less capital to help build your company. So it's a trade-off, price, size of round. Keep in mind that most VCs at early stage in businesses want to own a certain percentage of your company, usually minimum's 20%. But there's one other major factor that entrepreneurs don't know about in determining your valuation, and that is the size of the option pool that you have to set aside for future employees. The larger the option pool required of you, the actual lower the price the shareholders are actually paying. The size of an option pool that you're required to set up at the start of your company will depend how many senior managers you already have. If you already have a CTO, a head of product, a head of marketing, a head of ops, then you can argue for a smaller option pool. If it's mostly just you and maybe a junior team, you're going to be required to have a larger option pool, because investors know that you're going to actually have to recruit a team and give them options, and they don't want to take that dilution in the future. Liquidation preferences are who gets their money first in a downside scenario. If your company IPOs one day or sells for a lot of money, liquidation preferences are irrelevant, almost always. But the preference states that if you liquidate your company in a down scenario, that money comes out first. So if you've only raised $2 million and you raised it at an 8 pre, but you sell for $4 million in a year, even though the investor owns 20% of the company, they're going to get 50% of the proceeds. The $4 million sold, they get their $2 million back first. Think about it. It's not really fair if you raise $2 million and you sell for $4 million for you to take $3.2 million, which is 80%. Where preferences get tricky is if people ask for multiple preferences, like I want 2 times or 3 times my money. This usually happens in convertible note scenarios for a reason I won't cover today. The other thing to be really careful of is something called participating preferred, which are pretty evil. Participating preferred means that if you sell your company, I get my money back and I get my percentage ownership, so I kind of double dip. So I've given you the 4 major economic terms: price, size of option pool, size of round, and liquidation preferences. Now I'm going to cover a topic called governance. The first and most obvious part of governance is the board construct. How many board seats do investors get? In a perfect world, in an early stage company, the founders or executives will still have the majority of board seats. If investors have board control or board majority early in a company, they can often do things like even replace the CEO. So it's really important early in your company to fight to make sure that the founders have the majority of board members. Over time, in subsequent rounds, this usually doesn't hold. You usually end up with founders not having a majority. What you might want to push for over time is, for example, 2 founders, 2 investors, and 1 independent. Boards usually vote on things like budgets, strategy, executive team members, fundraising, stuff like that. In almost all term sheets, there's something called voting rights. These are the things that shareholders can vote over. The kind of things that they do is they prohibit, for example, raising a certain amount of debt or even raising an extra round of capital. These are not actually evil terms. They're designed to protect shareholders from actually being screwed from management. But if used by the wrong people or if constructed in the wrong way, voting rights can be used in a negative way. So just be careful of it. Next up is pro-rata rights. That's if I own a certain percentage of your company, let's say 10%, my pro-rata rights allow me to retain 10% ownership in future rounds as long as I'm willing to invest to keep my ownership. Pro-rata rights seem innocuous, and all VCs, if they invest large amounts of money, will ask for them. There are times where I see giving pro-rata rights out to too many people can actually cause you conflict. An experienced VC will often give up some of their pro-rata rights to allow future downstream investors to invest in your company. Some inexperienced or newer investors, often at earlier stages, will not give up their pro-rata rights. Sometimes this is okay. Sometimes this can be a right pin in your ass. So sometimes pro-rata rights are restricted to major investors or people who invest over a certain threshold of dollars of money. The next thing that you may negotiate is founder vesting. Here's what I mean. You may have worked for 4 years and have all your stock fully vested, but the next investor may require you to revest your stock. How could this be fair, you ask? If I give you $5 million and you can quit the day after I invest, I may have just put $5 million into a management that doesn't exist. So there's often a dance between new investors and existing management over founder vesting. The ninth right that you need to be aware of is called anti-dilution protection. In reasonably bullish markets like we have in 2016, it's usually not an issue, but here's what you should know. Anti-dilution protects investors in case you raise a future round at a lower price. What it does is it resets some of their investment dollars down to a lower price if you raise lower in the future. Almost every deal I see done in 2016 has weighted average anti-dilution. This is normal, this is fair, and this means you're most likely okay in a down round. What you want to be careful of is what's called a full ratchet. Full ratchet anti-dilution, not so good. What that means is if you do a down round in the future, then every one of my dollars automatically gets ratcheted down to that new price. So if you raise that $2 million at 8 pre for me and I originally owned 20% of your company, and then your next round is done at a 4 pre, for whatever reason, my $2 million ratchets down to 4 pre. So instead of owning 20% of your company, I now own 33%, and that's before I invest more money. This is one of the reasons I hate convertible notes on seed rounds. By definition, they all have full ratchets. The last topic is kind of esoteric, but I want to explain how it can be used against you. It's called a drag-along right. A drag-along right means that if somebody acquires your company, that investor can be dragged, forced to sell their stock. The reason is if Microsoft wants to buy your company for $100 million, you don't want a holdout that owns 5% to say, no, I'm not selling. Because Microsoft's not going to buy 95% of your company. It's 100% or nothing. So drag-along rights normally set a threshold, let's say 70%. If 70% of sellers sell, the other 30% get dragged. What you always want to do is calculate the percentage ownership an investor is going to own in your company and what the drag percentage is. If I own 22% of your company and the drag threshold is set at 80%, what that effectively means is I have a blocking right. You can never sell your company unless I approve. No rational investor, no decent investor would use that right to block a sale unless there was something nefarious going on. But unfortunately, I have seen it used in a hostile way. I've seen investors use it to negotiate other rights. So even though it's probably not something you need to worry about, you at least need to be aware of it. Always calculate thresholds and percentage ownerships. And know that usually when you're calculating those, you need to remove stock options from the calculation. Only actual shares are calculated. So that was a long primer. If you stuck around, I hope you got some value and at least understood the basics of term sheets. There's many great resources online you can look up, particularly Brad Feld. If you search Brad Feld in term sheets, you'll find a treasure trove of online knowledge.